Fed policy, AI capital spending, and a sharp drop in oil are pulling asset prices in different directions, and the cross-asset signals are not fully aligned. This is vTalkInsight, Allocator's Lens Daily for June 19th, 2026. We begin with equities, where a powerful earnings story is running straight into a more hawkish Federal Reserve. In equities, the central tension today is between an exceptionally strong AI and earnings narrative and a clear shift toward a more hawkish, less predictable Federal Reserve. That matters for portfolios because it challenges the generous multiples that have been assigned to growth stocks, just as policy uncertainty is rising and discount rates are moving higher. On the positive side, the growth story remains impressive. Hyperscalers are projected to spend around $1 trillion on data centers over time, feeding a powerful long-term demand pipeline for semiconductor suppliers and related infrastructure. The Philadelphia Semiconductor Index has pushed to record highs, with all of its constituents in the green, and names like NVIDIA and Micron are once again leading broader indices higher. Down the stack, AI-driven enterprise software platforms are reporting rapid revenue growth, faster customer adoption cycles measured in weeks, and strong annual recurring revenue momentum, particularly in the United States. More broadly, corporate earnings remain the main support for equity indices. Recent results have been solid, with continued upward revisions, helped by resilient U.S. consumer spending, including from retiring baby boomers deploying substantial savings. Lower energy prices are reinforcing that backdrop. Brent crude has dropped from peaks around $120 to the mid-70s, and that decline is widely seen as a significant tailwind for risk assets and a force that reduces recession risk. Against weaker economic fundamentals and energy challenges in Europe, the combination of robust U.S. demand, capex momentum, and a friendlier corporate tax regime keeps U.S. equity markets relatively attractive in a global context. The challenge is that a lot of this optimism already looks embedded in prices. A meaningful slice of the S&P 500 now trades at more than 10 times revenues, while large technology firms are seeing free cash flow squeezed by massive AI infrastructure spending. Those companies are increasingly issuing debt to fund capex, which raises their sensitivity to rates, just as the Fed turns more hawkish. At the index level, gains remain heavily concentrated in megacap tech. Semiconductors and AI-exposed platforms dominate performance, leaving the broader rally vulnerable if that leadership falters, even as some rotation into equal-weighted indices, smaller caps, and foreign markets starts to emerge. Supply dynamics add another layer. A wave of potential mega IPOs, including high-profile AI and space names, is set to increase equity supply at the same time as buybacks appear to be slowing, which could test the current supply-demand balance. Meanwhile, the Fed's more hawkish tone, the move away from detailed forward guidance, and higher front-end yields all argue for a higher equity risk premium than in recent years, even though indices have rebounded from the initial post-meeting wobble. For allocators, the key questions now are whether earnings and AI-driven growth can continue to outrun higher discount rates and richer valuations, and how quickly leadership can broaden beyond a narrow group of tech names. Those answers will depend heavily on the rates backdrop, which brings us to the bond market. Rates markets are digesting a clear hawkish shift from the Federal Reserve, combined with a move toward much greater data dependence. Officials have highlighted that inflation has been above target for more than 5 years, and the new chair has repeatedly stressed that restoring price stability and the 2% target now take precedence over labor market concerns. 9 of 18 policymakers currently see at least one additional hike as appropriate this year, and markets are close to fully pricing in a move by October, with some commentary pointing to the possibility of action even sooner. The immediate reaction has been most visible at the front end. 2-year Treasury yields jumped above 4.2% in their sharpest move in over a year after the press conference, triggering a pronounced bear flattener as the 2-10s spread narrowed to the mid-20s in basis points. Since then, front-end yields have eased back somewhat, suggesting the market is still probing for the right terminal rate. But the message is clear. Each meeting is now live, and investors can no longer rely on precise forward guidance. The Fed is also setting up several internal task forces to review key aspects of its framework, which adds a layer of institutional uncertainty about how policy might evolve over the next cycle. Set against that hawkish rhetoric, there are growing signs that inflation pressures are moderating. Core goods prices have turned negative month-on-month for the first time in over a year, and declines in energy and earlier one-off components, such as semiconductor costs, are expected to knock around 1 percentage point off core inflation in the second half. Market-based 5-year inflation expectations have fallen below levels seen around the start of the recent war shock, and some participants now see a realistic chance that inflation undershoots the Fed's own forecasts. That mix helps explain why market pricing points to roughly 1 to 1.5 additional hikes, but does not yet suggest a prolonged, aggressive tightening cycle. Looking ahead, the curve shape becomes critical for portfolio construction. One scenario is that the current bear flattening persists as the Fed edges rates higher, while longer-dated yields stay anchored by disinflation and policy credibility. Another, flagged in recent commentary, is a later re-steepening if rate cuts begin while balance sheet reduction continues, potentially pushing long-end yields higher and challenging duration-heavy strategies. For now, the combination of a 10-year yield around the mid-4s and some fixed income approaches offering roughly 6% at reduced duration underscores how much the yield backdrop has reset. But with the committee divided between hiking and holding, and the chair openly data dependent, front-end volatility is likely to remain a key cross-asset driver, feeding directly into credit markets. Credit markets are sitting at the intersection of this higher yield world and the ongoing search for income. In investment grade, yields in the 5 to 6% range are drawing strong demand, and much of the opportunity set is now framed in terms of carry rather than big directional bets on rates. That aligns with broader observations that fixed income yields have reset to more attractive levels overall, giving portfolios more built-in insulation against inflation than in the immediate post-pandemic period. The AI infrastructure boom is also reshaping who issues debt and why. Large technology and platform companies are ramping up bond issuance to fund massive data center and semiconductor investments, with aggregate AI-related spending expected to reach hundreds of billions this year alone. SpaceX is preparing a sizable bond sale with an investment-grade rating, aimed at financing expansion and data center partnerships that could more than double its revenues, illustrating how new economy borrowers are becoming a bigger presence in high-grade markets. In private credit, recent strains appear to be stabilizing rather than escalating. Redemption requests at one large fund have fallen by nearly half, allowing withdrawals to be fully met and easing immediate liquidity concerns. At the same time, institutional allocators are using the disruption as a moment to reassess how public and private credit fit together, with growing interest in private equity, private credit, and real assets as partial offsets to public market concentration and inflation risk. The main risk for credit remains that a more hawkish Fed and elevated real rates eventually pressure the most leveraged borrowers, especially in AI and tech-heavy sectors that have become more rate-sensitive. Spread behavior around future policy meetings will be an important signal. From there, we can see how these rate and credit dynamics are echoing through currency markets. In foreign exchange, the same policy and growth mix is lending support to the U.S. dollar. A more hawkish Fed, higher 2-year yields, and strong U.S. consumer and capex trends contrast with softer growth and ongoing structural challenges in parts of Europe. That relative backdrop keeps the dollar underpinned, particularly as U.S. assets continue to benefit from AI-driven earnings momentum and favorable domestic policy settings. Europe presents a more complicated picture. On one hand, lower oil prices are easing inflation pressures and reducing the need for additional tightening from the European Central Bank, which should support real incomes and sentiment. On the other hand, concerns about energy and defense sovereignty and recent moves to restrict advanced AI models add to an already challenging investment narrative, which can weigh on regional currencies over time. Geopolitics are reinforcing safe haven themes. Heightened tensions in the Middle East have pushed wealth flows toward international financial centers, with Swiss private banks in particular seeing increased inflows as clients move assets out of the region. That pattern underscores ongoing demand for perceived safe currencies in jurisdictions, even as risk appetite recovers elsewhere. For FX allocators, the key watch points are the evolution of Fed expectations, the durability of Europe's disinflation, and any escalation or de-escalation in the Iran and Strait of Hormuz framework, all of which will influence yield differentials and cross-border flows. commodities, and oil in particular round out the cross-asset picture. An interim United States and Iran deal and a ceasefire memorandum have reopened the Strait of Hormuz, driving a visible normalization in tanker traffic and Gulf export volumes. Brent crude has fallen to around $77 per barrel, with some estimates of flows showing liquefied natural gas shipments recovering toward half of their normal levels within weeks and much higher within a couple of months. Combined with earlier strategic stockpile releases, reduced Chinese imports, and alternative shipping routes, that has prevented a severe supply crunch and delivered a clear disinflationary impulse. The macro impact of that price move is significant. The slide from $120 to below $80 is seen as a major easing of inflation pressures, supportive of a softer stance from central banks over time and a key contributor to the soft landing narrative for global growth. In the euro area in particular, lower energy costs have reduced recession risks and taken some pressure off the European Central Bank, which in turn has helped to stabilize risk sentiment across regional equities and credit. Yet the new status quo is far from risk-free. The agreement around the strait is temporary, with a 60-day window and the prospect of future tolls or fees for passage, and it is perceived as heavily skewed in Iran's favor, with the United States signaling it could resume military action if terms are not honored. At the same time, inventories have been drawn down and current prices sit below the roughly $80 to $85 many see as necessary to incentivize new investment and drilling. That combination of underinvestment, destocking, and fragile geopolitics creates an asymmetric profile, where near-term downside in oil has been realized, but medium-term upside risk remains very much alive. How that balance evolves will be central to the inflation and policy debate, and by extension to the broader cross-asset narrative. Pulling the threads together, a more hawkish data-dependent Fed has pushed front-end yields and rate volatility higher, just as AI-driven earnings and sharply lower oil prices are supporting risk assets. Equities are caught between powerful growth in semiconductors and software and increasingly demanding valuations, with leadership still concentrated in a narrow group of tech names. Rates markets are signaling limited but real further tightening, alongside growing disinflation forces, while credit is enjoying more attractive carry and a stabilizing private segment. In FX, the dollar and safe havens remain supported by yield and geopolitical dynamics, and commodities deliver both relief and latent risk, with crude now a key swing factor for inflation and policy expectations. For allocators, the next phase hinges on upcoming inflation data, how the Fed balances its hawkish rhetoric with those disinflation signals, the shape of the Treasury curve, breadth in equity leadership, and the durability of the fragile oil truce in the Middle East. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.